I can't predict when it's going to happen, right? But what I can do is I can predict that we'll be ready when it does happen. The alternative to me isn't acceptable. So the alternative is to do nothing. Just get rid of everyone. Everyone goes home, works 3 days a week. We have two people in the office, and then suddenly the market turns around. You go, oh, no. So suddenly you're sitting there with this hollow shell, and you can't do anything. I really believe in this project. I believe in the team, and I really believe in the uranium space. And I've been in it long enough to see, the fundamentals of it. And anyone coming in, looking around, going, what commodity have I got the best leverage on? Well, we all know it's uranium.
Hello and welcome to Crux Investor. We spoke earlier today to Mike Young. He's the CEO of Vimy Resources. We discussed their recent private placement and how they intend to spend their money and what they're doing to cut their costs. We're talking about the uranium fatigue in the marketplace and timing of the price discovery. If you want to look at any of those topics, look in the description below. That'll take you to that point in the video. And if I could ask that you also click the button in the corner of the screen to subscribe to our YouTube channel. And if you want to see more videos like this, don't forget to click the notification bell. Let's hear what Mike had to say. Good morning, Mike. How are you?
Good morning. I'm very well. Very warm, actually. Summertime in Perth.
Lovely to hear that. Lovely to hear that. Not so much here. I've got my jumper on, as you may have noticed. Good to catch up with you before we get into the kind of Christmas break. Want to sort of catch up and see what you've been up to since we last spoke in September. We spoke at the WNA. You've done a fundraise since we spoke. Tell us about that.
Yeah, we did a placement, and then we did a share purchase plan, which allows basically our shareholders who reside in Australia and New Zealand to buy up to $30,000 worth of shares. So those two together raised 4.9 million, which was good, and topped up the coffers for us. Very happy to report that many of our major shareholders backed the placement. They came in, and we had to actually pare back some of the bids. So it was, as we say, oversubscribed and successful. So we're happy with that. And then while I'm on that subject, we had the AGM, and all the resolutions went through with very high votes. So the shareholders are pretty happy with our strategy now.
Yeah, yes, and so I guess that's the Forest family or Forest group followed their money. You said they would.
No, Forest didn't this time. They come and go. They've been in a couple of times. This time they chose not to.
Okay.
And we have discussions with them, and we're happy with why they didn't this time. Paradise followed their money. Mike Alkin followed their money, and some high net worth people we have out of Sydney who are very strong, long uranium backers followed their money as well. So, good support all around, but the Forest guys voted in favor of the resolutions, particularly the REM resolution. So our REM, we had one strike against us. In Australia, we have a rule that if more than 25% of people vote against the REM, the remuneration resolution, if that happens twice in a row, then you get a board spill. So it's always a bit of a risk. So last year we did in fact have one strike against us, but this year with the REM passed with about 99% support. So, we've done some cost cutting measures. We downsized the office. We've gone on to salary sacrifice, and some of us are on part-time. So the shareholders are happy now with what we're doing with respect to cost mitigation.
So what have you done? I mean, it's item number one on the AGM, the adoption of the remuneration report. What recommendations did you make?
So basically, the REM report is they're fairly pro forma, but during the year, one of the big things we did was the salary sacrifice that we did for all the senior executives and the board, and that was taken up by most of the execs, myself included. And then, as I said before, some of our guys have gone on part time. So that got support through the REM vote. So the REM vote is normally used by shareholders to basically vote displeasure against remuneration for the company.
Right.
And this time it got a thumbs up.
You used a phrase there. You said we've salary sacrifice, and some people are going part time. Why not just take less money and continue to work full time? What's the difference between those two options?
Well, I suppose everyone's got life, homes and debts and kids at school. So the idea with salary sacrifice, rather than just taking a pay cut, is that you are basically, it doesn't cost the company in terms of cash. There's not cash going out.
Sure.
and you're basically buying shares in the company. So it's just a way of preserving cash. Well, I suppose backing the company.
Right. So people are taking part of their salary or remuneration, sorry, as shares instead of cash. Is that what you just said?
Yeah, and yes, that's right, and that's something shareholders like to see the management buying shares in the company. And one thing I don't like doing is buying shares in the company I work for on the open market, because that means that I'm buying shares from someone who's selling shares, and that's not something I like doing, right? So what we do by doing it this way is that money doesn't go out of the company. So we actually maintain the money in the treasury, and then I'm getting paid in paper. So from a cash accounting point of view or a cash flow point of view, there's not cash going out. If you look at it on the balance sheet, well, then there's shares going out, but the dilutionary effect is very, very small. And the way it works is that at the end of each quarter, we look at a 5-year VWAP towards the end of the quarter, and that's what we get paid. So the share price has to go up for us to even break even. So it is a risk for us, but we believe in the company. I think that's the other important message, is the fact that we are taking part of our salary as shares, because we believe, right now we're undervalued.
Right. Okay. And I guess we'll talk about use of proceeds for the placement money in a second, because again, that comes back to your strategy, your go forward strategy. But just some of the other things on the AGM, just to sort of clarify for people. So, item number 2 was a spill resolution. What's that refer to?
So what happens if we had had our second strike this year? Then there would have been a resolution to spill, and because we didn't get our second strike, we actually, the REM passed with plus 75% of the vote. It was 99 point something. That resolution wasn't put to the meeting; it was withdrawn. So that's just uh, there are companies who've gone to the second motion, and then you have to spill the board, call an EGM, and have another vote for your board members.
You've done a number of share issues this year. You were talking about approval of additional placement capacity, which suggests that there will be more next year. Obviously, if you to take this forward, if the market recovers and you are to take this forward, that's just paving the way for that. So that's a relatively simple approval, was it?
Yeah, well, junior companies who aren't generating cash flow, that's their lifeblood. So rather than having an EGM, an extraordinary general meeting at the time that you place the shares, you can get pre-approval for up to 15% of your issued capital. So that's a normal resolution for any junior company at any EGM.
Okay. So let's get on to the placement. As you say, you raised money. I think when we talked previously, you said you were going to have to. It's a question of when that was, and all those wonderful factors like price in the market and market recovery, etc., come into play there. But you've done it at 5 cents. I'm sure you would wish to have done that at a higher price, but it is what it is. So, what was the conversation with shareholders, new and old, to say we need to raise this amount of money and this is what we're going to do? I mean, what was that conversation like?
Well, obviously we've had the same conversation before. The shareholders that we do have, they're pretty sticky. They believe in the uranium space, particularly Paradise, Forest. You've got Mike Alkin on there, some high net worths in Sydney. Morgan's has been very supportive. So all of the major shareholders, in fact, all of our major shareholders are supportive and understand the long nature of the uranium industry. We, like everyone else, would have expected more of a recovery than we're currently seeing, but the thesis is still the same, and the maths on the supply-demand imbalance are still the same. What we see as investors and what your viewers see is the spot price. And the spot price is not going to move until we start seeing significant volumes of American utilities, particularly coming into the market, into the contract market, because that flows through the spot market. And the other thing that's been interesting is just what Cameco's been up to, and it's really difficult to get see-through on how they're getting uranium stock without affecting the spot price. Because if you do simple maths on, how much volume goes through a spot market in any given year, not including if you corrected for the churn between traders, you would have expected that Cameco should have waded into the market in a much bigger way than they have. So there's a lot of questions being asked about where exactly are they getting uranium, and the simple answer is no, people don't know. We've got Scott Hyman, who works for us, who used to work for Cameco, and he was a fuel buyer and a fuel seller, and even he's scratching his head a bit as to what Cameco is up to. So that's a really interesting one, and I haven't got any answers on that one.
Yeah, I mean, it's been, the silence has been deafening, I think is the cliche that springs to mind over the last couple of months since WNA, certainly. Fund managers have gone quiet. Cameco's made a few announcements, but hasn't had the pop. No one really understands what the total supply situation looks like out there at the moment. It's a very opaque market in some ways, but not many people seem to know what's going on. I don't think anyone's got the answer. I don't think you're not unique in that sense. Can we get back to, if you don't mind, the money that you've raised? And because in your the press release came out, you're talking about strengthening the balance sheet, doing some exploration, and upgrading the DFS. I want to ask, the balance sheet that I get, you say, right, we've reduced costs, but we need to keep the lights on. We need to keep this thing going until this macro story comes through, right? Exploration, do you need to be spending money on exploration?
Well, we have an obligation to spend some because you have, under the laws of the land, you've got an obligation to spend money on the tenements. And I think in the territory it's about 400,000 a year, because we have mining leases at up at Mulga Rock, and it's a good thing we do, because if we didn't have mining leases at Mulga Rock, we wouldn't be progressing our project under the current state government. So because we had the mining leases granted before the current state government, we're allowed to progress. So those are expensive. The rents and rates we pay, I can't remember the number. It's well over $2 million a year in rents and rates and various government charges for the tenement holdings.
Wow.
Yeah. So we pay that to the local council and to the state. Fortunately, we were given relief from expenditure on those mining leases, which would be significant. So we're not spending any money at Mulga Rock. With respect to Alligator River, do you need to explore? Well, no one needs to explore. But if you want to develop new deposits and you want to be a mining company, then yes, you do need to explore. Alligator River is interesting because when we talk to utilities, one of the things they really like about Vimy is that we're not just a single mine company. We actually have a pipeline of projects, and what they want to see. You would have seen that one of the reactors in America was just licensed for 80 years. So these guys think on timelines much longer than junior miners normally do. And I'll give you a great example. So Scott Hyman used to work for Dominion Energy in America. He left them about 15 years ago. He worked for Cameco for 13 years. He's been with us for 2 years. When he goes and sees people at Dominion as a fuel seller now, he meets people he used to work with. So there are people working for Dominion Energy who have been working as fuel buyers longer than the lifetime of the Mulga Rock Project. So these guys think on huge time frames, right? If I tell them I've got a 15-year mine life, they're thinking, well, that's not long enough. We need to see a longer mine life. So you have to have a pipeline. And so to have a pipeline, you need to progress exploration. Now, there's different types of exploration. There's field work where you're doing mapping and sampling like we've done, terra sampling, or you can do wide space drilling. That's the next level of expense. Or you can do what's called a resource infill drilling. Now, that's really expensive because you've got to drill a lot of holes to define your ore body. So we have all three options. The whole Alligator River area is quite large. It's 80 kilometers long. There's many targets there at various stages. So next year, our field season is very limited. It's only 6 months because of the weather. The Angularly deposit, which needs infill drilling, this year probably isn't the year that we'll do it. But we're going to have to hop to it in the next few years because that's going to take about 5 years to move into a mine. And let's assume that Mulga Rock's up and running by 23, you'd want Angularity coming on stream about 3 years later. So it is a balance. But next year, we're not going to be doing infill drilling at Angularity because that can burn through a lot of cash. We've got some great targets at Southern Flank that you would have seen the announcement on the terra sampling. And then we've got there's a 20-kilometer long corridor between Sichuan and Angularli, where we've got some fantastic structures that we need to do some surface mapping and surface geochem so we can define some drill targets. But yeah, you need to keep the other problem. The other problem you run into is you have IP in a company. You have geologists who work for you, who've worked on projects for a long time, who understand the geology. When you stop working, you run the risk of losing those people, and that is IP you never get back. So you have this balancing act, right? And so that's me being I'm a development geologist, so I'm not an exploration geologist by any means. But one thing I do know about exploration geos is that IP that they have, they can write all the reports you like, but if they get bored and want to go work somewhere else, you've lost them and you've lost that IP. So there's this whole balancing act. You've got the human element of it. You've got your shareholders. Of course, you don't want to be wasting money. You don't want to go drill just for the sake of drilling. But on the other hand, you are an exploration development company, so you have to stay true to your vision and what your raison d'etre, if you like.
Right. So who do you think came out on top in terms of that balancing act? Because you've raised a bunch of money, quite a chunk of cash. You've got to work out how you spend that and when you think that's going to take you through to. I guess you're hoping for price discovery this year, and maybe we'll talk about maybe some of Scott's insights in a second. But when you were raising that, when you decided we need to raise some money, why did you pick that number? Could you have raised a lot less? Could you have raised more?
Well, we were limited by our placement capacity on how much we could raise, so we went to the maximum that we could raise. You raise less, you just end up coming back to market. So what we want to do is we really want to try and stay out of the market as long as we can.
So what does that tell us?
Well, that tells us that we're not going to be doing infill drilling at Angularli because that's going to burn through cash too quickly.
Okay.
So we're going to be very balanced. Now, the other thing we need to work on, which actually is a cheap option, which does have a lot of value uplift, is looking at the definitive feasibility study. It'll be 2 years old when it comes this January, so it'll have been 2 years since we released it. And so we need to just make sure that the assumptions in that are correct. The mining methods won't change because we spent a lot of time, effort, and money on that. What has changed is how much people cost, manning levels and things like that. So that's something we need to look at, and that can be done very cheaply. The other thing we want to do is try and get the capital down. And one of the big low-hanging fruits for that is, do we move from owner-operate on the equipment across to contract mining? And if we do, we want to try and mitigate. We want to try and somehow minimize the cost that of course the earth moving contractor is going to want for his profit. So there's some juggling we need to do, but those are cheap options. Those are things that aren't going to cost much money except for time and effort.
Yeah. I mean, they don't seem like major works to me. And so with the money,
but they're important.
No, I get they're important, but they're kind of like they're polishing while you're waiting, while you're walking circles around the room trying to.
No, I'd say no. I don't agree. I think they're more important than that. I think if we see the price discovery, I think we'll see next year, and we're writing contracts and we're moving down towards getting into funding. We need to have those numbers set in stone. So we can't be faffing around with do we do contract mining or do we own or operate 6 months from now? We need to have those answers in 6 months. So these are important considerations, because the one thing about having a DFS out in the market for a length of time is you get feedback, and one of the bits of feedback we get is, oh, the capital is a bit high, and so we have to look at ways of reducing that capital without having it slam our OPEX. So those are things that we need to look at, and they are important, but they're actually relatively cheap because you're using consultants' time. We're certainly not going to be on site drilling and digging holes again. So those are real value adds that we can do for not much.
So do you think on the current DFS you don't think you could get funded?
Well, if we were writing contracts at $55, we could, for sure.
Right. Okay. Well,
no, seriously.
Yeah.
Well, seriously, that's the number that we've got out in the market, right?
Right.
That's the number we've got out there as our incentive price. We used a $60 price for the DFS. Now, it's a no-brainer that if you can reduce your debt load, you can reduce, what you charge for contracts. Now, we've spent a lot of time and effort on this. We've done a lot of modeling on, okay, well, let's look at the balance between OPEX and CAPEX, because, if you can reduce your CAPEX and reduce your debt load, then that just means that you have less debt to repay, and you can actually offer cheaper contracts. And we've done a lot of work on that. So, it's pretty important.
Yeah, it's pretty important, but it's in the land of what ifs. If price discovery doesn't happen quickly, well, let's talk about that. So, spot price is where it is today.
But you have to. Sorry to interrupt.
Sure.
Sorry to interrupt. But you have to act like it will. So you can't be reactionary, right? And that goes to one of your other questions, and it was something we talked about a long time ago, I think. Somebody in the States said to me, "Why don't you just put your pencils down and wait for the market to recover?" And I said to him, "Well, the trick is to know how many pencils to put down, because you put them all down, when the market turns, you're going to be looking around for your pencils, and they're not going to be there, right?" So we found it. I think we found what is a good balance.
Okay.
But I don't want to be suddenly caught on the hop when the music stops and in the game of musical chairs, and suddenly all the utilities are scrambling around to get contracts, and we're not ready for that. We have to be ready for that.
Yeah, well, again, I think let's come on to that, because let's talk about timing, but we'll come on to your strategy, because that's really important in terms of where you think you fit in the mix. And obviously with Scott's history of buying and selling, you're probably reasonably well informed on that. So, but on timing, it's coming up for Christmas. No one's going to do anything. It's eggnog season, and people are a bit more relaxed. So what happens in January? What happens next year? How quickly do you think this comes? When it, if it comes, and when it comes, how quickly does it go?
Well, I don't think it's not a matter of if. I mean, you can just look at the utilities running down their inventories. Right?
If for next year. The question can be if for next year, because we don't know what the inventory numbers are. No one seems to know what the inventory numbers are. So it's not a question of if it comes eventually. It's a question of if it comes next year.
I mean, I'm using the same crystal ball as everyone else, and it seems to be very, out of batteries, more or less. I mean, we all thought by this time the price would be around 30, and it's hovering around 26, right? So there's these sort of little, I guess, I don't know, you call it hurdles, I guess, as you go along. So I can't predict when it's going to happen, right? But what I can do is I can predict that we'll be ready when it does happen, because the alternative to me isn't acceptable. So the alternative is to do nothing, just get rid of everyone. Everyone goes home, works 3 days a week. We have 2 people in the office, and then suddenly the market turns around. You go, "Oh, Marcel, can you come back to work for me?" "No, I've got another job now." "Xavier, can you come back to work?" No, I'm working somewhere else. So suddenly you're sitting there with this hollow shell, and you can't do anything.
No, I get it. We've all been there. But let's come back to the market question. No one's got a sense of when this comes back. But with your conversations with Scott, what's he telling you as an ex-buyer and seller for utilities? What does he know that we don't?
Well, the problem you've got is that we're having confidential conversations with utilities, and I'm reluctant to actually disclose. So that's.
But you are having conversations. You are having conversations.
Oh yeah, absolutely. Yeah, right. Yeah.
And they're giving you what insight as to how they behave, what their expectations are. Anything
that's
on timing?
How they behave. So how they behave, how they'll behave when they get back into the market. We are doing, when RFPs come out, we're participating, so we're getting feedback on price discovery. And all of those things, when you take all of those things together, and then you consider our strategy, that should be telling you that the news we're getting from the utilities is confirming that we need to keep going forward with our strategy, if that makes sense. That's about as far as I can really go, because Scott's giving me a bunch of news from the utilities, and we're just getting more and more ready. So,
right. Okay. Yeah. So that does tell us something. You're telling me it tells me something, so that's good. So let's talk.
How does it go? I'll imply, you infer.
Let's agree to do that. So let's talk about that strategy bit. So you've got this balancing act of how you spend and apportion the money that you've got at the current run rate, without anything changing. You've got enough cash to take you through to the end of next year, assuming nothing changes.
Probably a little bit less. Probably into certainly the end of the financial year, into the second half of calendar year. Right. If nothing changes.
Okay. But if something does change, then you go to the market. You're going to go to the market at presumably a higher share
You would only
price.
go on bet. You would go to the better. Yes, you would go to the market earlier on a better share price for
Yeah.
sure.
Okay. Appreciate that's all you can say on that. Can we just talk about working group? It kind of follows on from the Scott conversation. Working group. You did make a couple of predictions when we spoke a couple of times ago, a couple of interviews ago, as to the tinkering that would happen, but no real sort of meaningful outputs. I mean, has your view changed? I mean, from what you've seen or what we haven't seen from the working group? I mean, been a couple of leaks, but nothing concrete.
No, and the leaks were about I think DoD or DOE buying uranium from the domestic miners, and that was always what we believed was going to be one of the recommendations. There may be some tax relief. Certainly, I don't know what the scope. What I do know is I think the working group went to the government with about 60 recommendations. We were told to go away and narrow down the list. That was one of the things some of the feedback we got.
Okay.
The other thing is it seems to have just they'll present it to the White House, and the White House has no time limit to accept or release the results. So these leaks are actually quite useful. But everything we've seen leak-wise has been pretty much in line with what we thought, and what we've said in the past is that it will be tinkered. There's not going to be any tariffs. It's not going to be any quotas. So I think people. It does cause uncertainty with some investors, but I think the utilities have moved beyond. The utilities certainly don't talk about the fuel working group like they did about the Section 232. So that had a really profound effect on their actions. But the nuclear fuel working group now, they just see that as tinkering, and there's nobody talking about grandfathering contracts and all of the concerns that they had the 232 when that was out there in live.
Okay, so this is going to come back to market dynamics, supply demand, fundamentals.
Yeah.
It's not going to be about policies or tariffs and so forth. This is how much do we need? When do we need to pull the trigger? Okay, that makes sense to me, because why, for buyers, why would you not continue to buy as cheaply as possible for as long as possible up until the threshold which you've defined? It makes nothing more than sense to me.
Well, the threshold is getting uranium. The one thing that I've learned from Scott is that you've got three competing forces in the utility. You've basically got the CFO who manages cash flows, and he has other concerns, right? So he's got turbine blades to replace and seals, so he's got to put his capital somewhere else. The CNO, the chief nuclear officer, whose one and only rule is thou shalt not run out of fuel. And then you've got the risk lawyers, and they're the guys who are sort of balancing, okay, what's the market look like? What are our inventories like? And what's really interesting is there's a lot more headwinds now than there used to be. So you've got the Russian suspension agreement, which comes up at the end of 2020, which limits how much uranium can come in and product can come in from EUP can come in from Russia. You've got the Iranian waivers, which are now suddenly bubbled to the top. And the Iranians, you've got, they decide to give them another 90 days. And 2 days after the American make that announcement on October 30th, they decide to start enriching uranium again. So, that if those waivers go away, then anyone dealing with Iran's nuclear program is at risk of basically being barred from trading with America. So that's a real concern for the Americans, right? So,
but not Europe.
And these are just uncertainties. Probably not so much.
No.
I don't know. No, because I don't know what the Europeans are going to do if they don't have a waiver, an Iranian waiver.
No, but that's my point. It's like the Americans are unilaterally coming up with their own view, and the EU fundamentally disagrees with the way that the whole Iranian play is unfolding in front of us. So again, more confusion, more uncertainty.
Well, that's true, but America's, I think it's 28% of the market. So it's certainly the customer we're concentrating on. So, the EU is dominated by EDF, and the EDF fuel buyers have said that they'll only buy from existing producers. So that leaves us out until the next round of negotiations. So we concentrate on the US market. That's the market that we're interested in, and that's the market that, they're the guys that we watch, and their reaction to the Iranian waivers is really important to us.
What else has Scott given you insight into in terms of, when utilities start making decisions? Is January a time of year where things happen? I mean, I've heard that typically January is when it kind of kicks things off.
So Scotty said basically what happens is very few companies will during December and during the holidays, very few utilities will put out RFPs. Remember what I said earlier, they think on long time frames. So, waiting until January to put out an RFP for fuel is fine. They're not in a hurry. There have been exceptions to that rule. Scott said once they had to do an RFP between Christmas and New Year's, and they were all highly annoyed that they had to do that. There's a one-day NEI conference in Washington in January. I think it's in mid-January, and that's kind of the starting gun for the new year. And Scott said that's always been the case. So everyone, they drop the eggnog, they head to Washington, they all get back together. January and February, Scotty said, are months that they are buying fuel. A lot of reactors have just come down through outages, what they call outages or refueling. So that's all done. Some of the smaller teams, it's all hands on deck. So they might be part of the fuel buying department, but they're also nuclear scientists that are involved with the outages, which I always find a funny name. It's got a negative connotation. It should be, rebirth or something. We're refueling the reactor for the next year or two. But something else Scott said in our meetings with utilities that I hadn't really thought about was, while the U.S. aren't building new reactors at a breakneck pace, I think there's 2 under construction at the moment. One thing they have done is they've increased their capacity factor quite a lot, and the capacity factor has gone up significantly. And that's, that while that's not a huge amount of growth, it's still a positive sign for the industry. And then if you take that in conjunction with, where the WNA's growth rate is of 2%, it's getting a little bit healthier than it has been in the past. And one thing we're seeing is, we've got COP25 going on now in Europe, and we've got there are pro-nuclear groups actually speaking at it this time, whereas the last one they had in Poland, I think the nuclear lobby was still frozen out. You had the European Parliament voting in favor of nuclear power as a way of mitigating climate change. So there's an interesting sea change happening around the world, and you read the news as much as I do. There is this overwhelming consensus that there's a climate emergency and we have to do something about it, and nuclear is certainly starting to be part of that.
Yeah, for sure. I think that the macro story is being better understood and better told, for sure. Let's just finish off with for your hopes for this year for Vimy. I mean, what would you say to new investors looking at Vimy? Where do you sit in the market? Why should they be coming in now?
Okay. Well, let me get where's my nuclear fuel report is somewhere. Julian's coming board it. Right. So when you look at the market right now, there's far less uranium being produced than there is being burnt in a given year. I think the numbers are 125 being produced and about 178 being burned, something of that order. Now, a lot of the utilities are running down stockpiles and inventories. But what's happened is because of the prolonged low price caused by overproduction out of Kazakhstan, basically you've had mines close, and importantly, you haven't had a lot of new mines being developed. And that's really where I think Vimy sets itself aside with a very small select group of guys like the bosses of the world, where we've just kind of quietly kept our projects moving forward. And when you look at the WNA report, they have a couple of categories. And that was one of the things we talked about, how important this year's report was they actually started to break down some of the production. And one of the things is planned mines. And planned mines are basically mines that have done a DFS or a PFS and are basically ready to move forward. And there's only, I think, 6 of those in the world. There's 4 under development at the moment. There's 6 planned mines, and then there's a group of prospective mines, and Angularity comes into that group. And then you've got the next low category down, which is what they call the reserve mines, which is the ones that are on the bench, and they could come on at some point in the future with better prices or more studies. So when you look at if there is a supply shock and suddenly we need to turn on more supply, and I don't think it's an if, but I think Cameco and Kazatomprom will maintain their supply discipline. They don't want to see the price plummet again. They've both said that. They both want to see sustainably high prices. you're still going to have new production if you've got growth and you've got mines closing because they're running out of resources. So when you look around and you say, well, who are going to be the next generation of miners? And this is the same as any commodity, whether it's nickel, copper, gold, it doesn't matter. Mines run out of ore. They are finite resources. And what happens is as mines close down, you need new ones coming on. And there's not very many new ones out there. And when you look at the supply curve going forward, there aren't a lot of new planned mines, and we're one of them. So, we're in that sweet spot where, let's say next year goes well, let's say we're writing contracts, and by the end of the year, we're looking at funding, and by early 21, we're getting into construction, and then 23, we come into production. And when you look at anyone's predictions by 23, what the price is going to be, it doesn't matter who you look at. By 23, the prices have to be significantly higher than they are today, or you're just not going to have uranium. People look at today's spot price, which is $25, just under $26, and for some reason they think that's the price going forward forever, and it just isn't. And we're as I said before, we are entering into RFPs. We know where our price expectations are, right? So we're not out of the ballpark. If we were, we wouldn't be doing what we're doing.
Okay.
You see, so when you look at 23 and 24, 23 being first production, what's the price we're going to get then? It's not what is the price today, it's what's the price in 3 years. That's the important thing. And the feedback we're getting is our price expectation is not unrealistic.
Okay. And I guess the trick that you need to master is being able to show people that you're going to be able to get from here to 2023 fully funded into production, selling into the market with your contracts and so forth, without affecting the share price negatively. So, they've got to be able to look at and work out what's the best timing to come in and join the party with Vimy Resources. When would you say that timing is?
About a week ago.
Okay. Right.
No, I think, seriously, I think I don't like doing dilutive raises. I'm a shareholder. I bought shares years ago when we first joined the company. We bought a bunch of shares from the founder. And we've had shares as part of our REM who they've basically fallen away because the share price hasn't been sustained. I'm as unhappy as anyone with the share price being where it is. Especially when you look at our peers on a comparative basis. So that's even more frustrating. So I have to work hard at keeping the story out there. We've got a conference this week down here in Perth called the New World Metals Conference, which is battery metals and uranium and things like that. We just have to keep in front of people and keep telling them the message and keep on message. And we want to make sure that the raise we've just done lasts. We need to be as smart as we've been with our money to make sure we're not popping into the market again early next year, because if we do that again, the share price will fall again and people get diluted. So we need to be, what you want, the perfect world is, okay, we see the recovery, the share price recovers, and then the next time we need to raise some money, it's not as dilutive. We're not raising our full 15%. We're raising far less because the share price is around 10 cents. So, that's how you run these companies. I've done this before. I ran an iron company. I've been associated with gold companies. And it's a hard balancing act. Sometimes people end up with 3 billion shares on issue because they just keep putting out these small raises. And sometimes they're raising something like 150 grand because all they're doing is they've got a small service, office, and they just have to keep paying to keep the company public until there's better times. But, we want to avoid that cycle. We want to try and really, be doing something to benefit the projects, but also watching our cash, and it is a balancing act.
It is for sure, Mike. Thanks very much for that update. I hope it goes well over the next couple of quarters. We'll see what if there's price discovery in the market, because I think that's the biggest mover of the dial for you guys.
It is a contract. A contract is that'll be seriously life-changing for everyone.
Yeah,
but that's what everyone's waiting for. And as I said before, we do enough work inside the contract market by being participants to know exactly where we sit. And this is one of the things that frustrates me about the consensus forecasts. And we saw Mike Elkins talk at Nashville is that it doesn't paint the whole picture. It does not paint the whole picture. And so, unfortunately, Mike's out there trying to tell the message, but unfortunately, there's only two consensus views in this market, and it's not relaying the information that we get by having a guy like Scott working for us.
I think that's true. Well, stay in touch. Good luck over the next couple of quarters. Let's speak in the new year, and hopefully it's
I'd like
positive news.
Look, I wouldn't be doing this if I didn't think it would be, right? So, there's a lot of opportunities pop up and bubble up, and but I really believe in this space. I love the space, and I really believe in what we're doing. I mean, I could go draw a check somewhere else. I could do gold. I could do nickel. But I really believe in this project. I believe in the team, and I really believe in the uranium space. And I've been in it long enough to see, the fundamentals of it. I'm not delusional by any means. It'd be a whole lot easier running a gold company, but I really think, when you look at leverage, gold is pretty much, it's not gonna double in price, right? So gold is a yield play now, whereas uranium is a good leverage play. And anyone coming in, looking around, going, what commodity have I got the best leverage on? Well, we all know it's uranium, but you got to be a long. So hopefully next year's Christmas present will be much better than this year's.
Thanks very much for watching. We hope you enjoyed that. And if you did, please click the button in the corner of the screen to subscribe to our YouTube channel. You can also catch us on our website, cruxinvestor.com, and Cruxcast, our podcast series. Plus, most days you can catch us on LinkedIn and Twitter. We'd love getting your feedback, so please keep that coming, and we'll speak to you again soon.